Hey everyone, welcome back to World of SDT. Today we're diving into a topic crucial for everyone, personal finance. In this journey of mastering your money, the first milestone is setting clear financial goals. This isn't just about the end game like retiring on a beach somewhere. It's about real, achievable targets that will guide your financial decisions and keep you on track. Think of it as setting a destination in your GPS before you start your car. Without a clear direction, you might end up anywhere. So what are your short-term goals? These could be anything from saving for a dream vacation, buying a new gadget, or even paying off a credit card. On the other hand, long-term goals require a bit more planning and patience. This could be buying your first home, saving for your children's education, or creating a retirement nest egg. These goals are not achieved overnight, but with consistent effort and smart decisions, you can reach them. Remember, the key is to be specific. Instead of saying, "I want to save money," say, "I want to save $10,000 for a down payment on a house in the next 5 years." This gives you a clear target to aim for and makes your goal measurable. So, what are you working towards? Write down your goals to give yourself a roadmap for success. Now, on to budgeting. Think of it as your financial GPS. It's a tool that guides you on your financial journey, helping you navigate income, expenses, and savings. Without it, you're essentially driving blind, with no clear idea of where your money is going or how to reach your financial goals. Creating a budget is straightforward. Start by listing all your sources of income. This could be your salary, freelance gigs, or even a side hustle. Your income is the fuel that drives your financial vehicle. Next, map out your monthly expenses. These are the roads and highways your money travels on. Include fixed expenses like rent or mortgage payments, utilities, and car payments. Don't forget to factor in variable expenses like groceries, transportation, entertainment, and personal care. This can fluctuate from month to month, so try to estimate an average amount. Now here's the tricky part: savings. It's all too easy to think of savings as what's left after all your spending. But it's more beneficial to consider savings as a non-negotiable monthly expense. Every month, allocate a portion of your income to a savings account. Think of it as paying your future self. Lastly, make room in your budget for emergencies. Life is full of unexpected twists and turns, and having a financial cushion can soften the impact. Whether it's a car repair, medical expense, or job loss, an emergency fund can be a financial lifesaver. Once you've laid out your income, expenses, savings, and emergency funds, it's time to fine-tune your budget. Adjust as necessary until you find a balance that works for you. Remember, a budget isn't set in stone. It's a flexible tool that should adapt to your changing needs and goals. In essence, a budget isn't about restriction. It's about understanding your financial landscape and making informed decisions. It's about being in control of your money, rather than letting your money control you. Remember, a budget is a tool that helps you stay financially on track. So, buckle up, turn on your financial GPS, and enjoy the ride to financial freedom. Let's talk about building an emergency fund, a crucial part of financial stability. We all know that life is as unpredictable as it is beautiful. One day, you're sailing smoothly, and the next, you might hit an unexpected financial bump. That's where an emergency fund comes in. It acts like a safety net, catching you when unforeseen expenses come swinging your way. Imagine it as a buffer between you and life's little surprises, whether it's a sudden car repair, a medical emergency, or an unexpected job loss. It helps you navigate these situations without the added stress of derailing your financial plans or accumulating unwanted debt. So, what's the magic number? Financial experts suggest saving at least 3 to 6 months worth of living expenses. It might seem like a daunting task, but remember, every little bit counts. Start small, be consistent, and before you know it, you'll have built a sturdy safety net. Having a safety net can help you weather unexpected expenses without derailing your financial plans. Your credit score plays a significant role in your financial health. Think of it like a report card for your finances. It's a 3-digit number that lenders use to evaluate your creditworthiness. The higher your score, the better deals you'll get on loans and credit cards. So, how can you maintain a good credit score? The formula for a healthy score includes timely payments, a mix of credit types, and managing your credit utilization. Make it a habit to pay your bills on time, every time. This shows lenders that you're responsible and reliable. Next, diversify your credit. This doesn't mean you need to rush out and apply for every type of credit possible. It simply means having a mix of credit types, such as a car loan, a mortgage, and a few credit cards, can demonstrate your ability to manage different types of credit. Credit utilization is another factor. This is the percentage of your available credit that you're using. As a rule of thumb, try to keep your credit utilization below 30%. This shows lenders that you're not over-reliant on credit. Now let's talk about debt management. Managing your debts wisely can positively impact your financial health. If you have multiple debts, focus on paying off the ones with the highest interest rates first. This is known as the avalanche method and can save you money in the long run. Another strategy is debt consolidation. This involves combining multiple debts into one, ideally with a lower interest rate. This can simplify your repayment strategy and potentially reduce the amount you pay in interest. Remember, just as your physical health benefits from regular checkups, so too does your financial health. Regularly check your credit report for any errors and to monitor your credit score. You're entitled to a free credit report from each of the 3 major credit bureaus every year. In conclusion, maintaining a good credit score and managing your debts wisely are essential steps towards financial stability. Keep an eye on your credit report and manage your debts wisely for a healthier financial future. Once you've built a solid foundation, it's time to talk about investing. Now picture this. Imagine you're a gardener, and your task is to grow a lush, thriving garden. In this analogy, your garden represents your financial future, and the seeds you plant are your investments. Investing is a powerful tool that can help you grow your wealth over time. It's not about getting rich quick, it's about steadily building wealth over the long haul. And the magic ingredient that makes this possible is compound interest. Think of compound interest as a snowball rolling down a hill. It starts small, but as it rolls, it gathers more snow and gets bigger. The same principle applies to your investments. The returns you earn are reinvested, and they in turn earn more returns. Over time, this snowball effect can significantly increase the value of your investments. But where do you start? There are several investment vehicles available, such as 401(k) plans or individual retirement accounts, also known as IRAs. These are special types of accounts designed to help you save for retirement, and they often come with tax advantages. A 401(k) is typically offered through your employer, who may even match a portion of your contributions. That's like getting free money, so if you have access to a 401(k), take full advantage of it. An IRA, on the other hand, is an account you open on your own. There are 2 main types, traditional and Roth IRAs. Each has its own tax benefits and withdrawal rules, so do your research to decide which is best for you. Regardless of the investment vehicle you choose, there are 2 key principles to keep in mind. First, start investing as early as possible. The sooner you start, the more time your money has to grow. And second, diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across a variety of assets to reduce risk and increase potential returns. Investing may seem complex, but remember, it's all about planting seeds for your financial future. Start early, diversify your portfolio, and watch your financial garden grow. Retirement may seem like a distant goal, but the earlier you start planning, the better. It's like planting a tree. The best time to do it was 20 years ago. The second best time is now. The same principle applies to retirement planning. The earlier you start, the more time your investments have to grow, thanks to the power of compound interest. Think of retirement planning as a journey. It's not about reaching a specific destination, but about creating a plan that can help you live comfortably in your golden years. This journey begins with understanding the retirement options available to you. For many, this includes employer-sponsored retirement plans such as a 401(k) or a 403(b). These plans offer tax advantages and often include an employer match, which is essentially free money contributing towards your retirement. But don't stop there. Consistency is key in retirement planning. Make it a habit to regularly contribute to your retirement funds. Even small, consistent contributions can grow into a substantial nest egg over time. And remember, your retirement plan shouldn't be a one-size-fits-all solution. Consider exploring additional retirement savings options such as an IRA or a Roth IRA, which offer different tax advantages. In conclusion, retirement planning is an essential part of mastering your money. It requires foresight, consistency, and a willingness to take advantage of the resources available to you. It's never too early to secure a comfortable retirement.